Hello traders, this is Dan, and in this Master Trader Weekly Trade Review, we're going to discuss a bullish option strategy that we used last week on a couple of trades on bullish bounces. Let's begin. Here's a little checklist we use for trading options with the charts, which is the Master Trader approach. Whatever we trade, we're technical based traders. We're looking for a high probability setup, and then we see where that setup is in connection with the overall trend, support and resistance, multiple time frames, what are the broader markets doing, is it showing relative strength or weakness. Put all those concepts together, and then we have a high probability setup or not. So that's step one here. Give me a compelling pattern using the Master Trader approach. Then we both buy options and sell options based on our bias of the underlying, and obviously teach that in our courses. Then which type of directional or income strategy are we going to use? What strike price? How many days to expiration? Is it going to be a spread, a diagonal? Once we pick that to match our bias, then we calculate proper position size per our trading plan, enter and manage in between. But whether we're trading stocks or options, of course we're watching implied volatility, and if we're short options, the percent max gain, if it's a rapid gain or not. But in any event, we're primarily using the charts and use adjustment strategies to manage the position to closure. Here's one of them, XLE, which is an oil ETF, the strongest sector this year, and just all the oil's been very strong. So this is a continuation pattern. Now, we don't trade breakouts that run from the low of the base to the top of the base unless there's some type of correction. And so the price action that we noticed here was big ugly red bar suggesting lower prices, gap down, close fine, higher high, higher low, green bar, 90% retracement. On this bar, it had a bearish gap down, went back to the prior day's low, and closed with a higher high at resistance. The next day, it gapped over these bars with a price void. It's at multiple months highs. You can see the 20 is the blue line, 50 MA the green line. So we have short, intermediate, and although not shown, the 200 are they're all up. So this is a continuation pattern. This is actually a closed trade, but it shows you the history. We bought the June 3rd 80-89 bull call debit spread. So could we have just bought calls alone and profit as the stock moves up? The answer is yes. But when we do a bull call debit spread, we're buying one call option. So we bought the 80s and we sold or shorted the 89s. And so that lowers the cost of the $80 call and increases the probability of profit, because the premium that we're receiving on this $89 call is actually giving us what's called positive time decay. So we lump these into what we call mildly bullish trades as opposed to fully bullish. If we were fully bullish, we'd just buy a call option. And so in this case, because gap breakout, but sloppy here, we decided to use the call spread. But you can see here we had a beautiful run, and then we sold half. Look at this, a nice 40% quick gain. And then with the gap up, so on this red bar right here, I said with the gap up and it's getting extended, I said just sell it. Sell at 809, take the money, nice trade. So the net gain on this trade, and this is just on one contract right here, so we made 43.5% return on our bull call debit spread that cost us $552. We made $240 on that trade. We did one on this, the IWM is one of the index ETFs. And the markets got oversold here, and they were all putting in similar type of W bottoms. So this is what we call the turn. It's making the turn right here, and it's not a fully slam. Again, just buy a call option. So we elected for the bull call debit spread. So we bought the 175 in the money calls, and we do them because it gives us the amount of proper delta. It's a nice trade-off. We like 80 delta or higher because that means that as the underlying goes up $1, we make 80 cents, which is the delta. And it's a good trade-off between the amount of money you're going to make and time decay. But then by selling the 188s, and you can see here the 188s was a perfect short strike to sell. We lowered our cost basis like we did in XLE, and you want to try to pick a far enough strike where you think is the stock's not going to go through, because if it just barrels through your short strike, you still make your maximum gain, but you're capping your gains. So again, this was a closed trade. Here's the history, and we always give the strategy, the symbol, the date, and the technical setup. This one was a continuation of a W bottom, so the entry was over the high of this green bar, and although not shown, the weekly chart was a climactic buy setup. But in 6 days on this one, nice little swing trade here, we made almost 30% return. So the beautiful thing of trading options and spreads is we participate and profit in our directional bias with leverage. If you were to buy whether 100 or 1,000 shares, you do the math on this, when this stock was at rough, let's just call it 180 bucks, think of the capital that would tie up as opposed to $6.85 a share. And then so we make higher returns with leverage and limited risk. If we had some crazy ugly gap down, whenever you're buying options, your maximum gain is what you paid for it. So if this happened to gap down $20 and you were long IWM, well then you lose $20 a share. Our maximum loss is $6.85 a share. So two great trades there when we were trading these little bear market bounces in the broader markets. If you want to learn how to trade options using the Master Trader approach, again, both selling options. We have two versions of the credit spread courses, and this is where we sell short-term expiring options that round these compelling turns using Master Trader strategies, and then the money that we receive is our potential maximum gain in the trade, and we just pick a strike where the chart suggests it's not going to go to expiration, and we manage in between. Directional options, which is what these two examples were, it's buying options to profit on our directional bias, again with leverage and limited risk. Hope that helps. Any questions, email Greg or me, and we will see you in the next trade review video.